Hello, this is Hixon Zuercher from Hixon Zuercher Capital Management with our July 2017 economic update. In today's video, we'll talk about some of the economic headlines that influenced markets in June and give you some insight into what they could mean for you as an investor. Well, it might be hard to believe, but we've already wrapped up the first half of trading for 2017. In the first 6 months of this year were marked by strong stock market returns and exceptionally calm markets. Despite the ongoing conflicts in Washington, Wall Street is still in rally mode. The S&P 500 and the Dow Jones Industrial Average each rose 8% during the first half of 2017, which is the best start since 2013. The NASDAQ also marked its strongest first half of the year since 2009 with a return of 14%. Stocks have been lifted by the sense that other global economies, particularly in Europe, are starting to stabilize. Not all stocks have risen though. The S&P 500 telecommunications sector, which includes phone and internet providers, as well as the energy sector, including oil and gas companies, are both down. Our economy slowed less in the first quarter than initially anticipated because of unexpectedly higher consumer spending and a big jump in exports. The U.S. gross domestic product, which is the total value of goods produced and services provided in a country during 1 year, increased at a 1.4% annual rate. While this is positive growth, it is still the slowest growth rate since the second quarter of 2016. Job growth has been steady, and consumers are feeling better about their ability to pay their bills, take some trips, and cover other expenses. Americans' personal income soared in June, but that extra cash didn't seem to prompt consumers into spending. Personal consumption expenditures in June only gained 0.1%, which was the worst showing since February. Spending had rebounded in March and April after starting the year on a soft note, but the latest reports suggest that consumers are now being more frugal once again despite their pay increases. So what can we expect from the markets over the next 6 months? Well, looking into the second half of 2017, it's unlikely that the low volatility that we've seen so far this year will persist indefinitely. Investors should brace for more big swings in the market, both up and down, in the coming months. Wall Street will be focused on whether corporate earnings can continue rising at a healthy pace despite what is going on in Washington and around the globe. Some things that you might want to pay attention to that could stall future gains is a market that has become a bit expensive compared to its long-term average, political gridlock, a slow-growing economy, and worries about top-performing tech stocks cooling off. There's also a feeling that the market's fast start has stolen some gains that may have come later this year. Well, that's it for today's economic update for the month of July. And as always, if you have any questions or concerns about what we've discussed or your own financial situation, please give our office a call at 419-425-2400. Or you can always email us at hello@hccapital.com. I hope you continue to enjoy your summer, and we'll see you again in August.